Good morning, everyone. Sorry about the short delay there. Can everybody see the screen up for our webinar?
Yep, I see the screen. This is Adam.
Okay. And then it looks like we have a number of attendees coming on board. If anyone can't see the screen or hear my voice or feel like they're not seeing anything, please go ahead and just go ahead and put a message there on the chat board. Good morning to everyone. Friday the 15th of December. Happy holidays all around, or whatever you're celebrating. We're going to have a great panel this morning. I'm going to just quickly get everybody online here and then pass the mic over to Kim, who will be running this session along with our great lineup of speakers. So just do a check here. Kim, you can hear me, can't you?
Yes, I can hear you just fine. Can you hear me?
Okay. We are going to go ahead and get started. Kim, I'll go ahead and let you jump in as our moderator for the day, introduce the speakers, and we'll go ahead and get started.
Okay, please remember to press the record.
You got it.
Well, good morning, everyone. Thanks so much for joining us for this exciting, engaging webinar as we close out 2017. We're closing on a really strong form. Today's webinar is Accessing Expert and CEO Insights to Utilizing Revenue-Based Financing to Scale Your Growth. And our speakers today include Linda Amaro, who is the CEO of Klarient Solutions, BJ Lackland, who is the CEO of Lighter Capital, and Adam Zeigen, who is the co-founder and CEO of Rock My World. As a backdrop to our discussion today, as many of you know, there's a growing market for alternative financing for early and growth stage companies, including the option of revenue financing. There are mechanics to this type of, many people ask, what are the mechanics to this type of funding of revenue? What information do you need to know? How do you access and close new options for financing? Well, in this webinar, we're going to cover those, as well as share with you the perspectives of two successful CEOs who have had an opportunity to take advantage of this line of funding. Additionally, we're going to include a discussion around, some of the issues that are very prevalent and talked about today about the lack of access to capital for underserved markets and how revenue-based financing can provide a quantifiable, unbiased source of capital to this fast-growing emerging market. So with that, let me start by introducing our speakers. I mentioned them by name, but I would like to tell you a little bit about them. As I mentioned, Linda is the CEO of Klarient Solutions. She's been a technology and business leader for more than 25 years, and she's brought sanity and confidence and success to the industry she's contributed, which include manufacturing, transportation, insurance, data management, software development, and biopharma. Her diverse experience creating strategic plans, leading organizations through change brings a high degree of success to those she partners with. She's been the CEO of Klarient Solutions for over 7 years. They help this small companies has an opportunity to attract talent from across the country, and they help businesses with connecting their virtual office. Next, I'd like to introduce BJ Lackland, who is the CEO of Lighter Capital. He spent his career working with emerging technology companies as an operator, executive, and investor. Before Lighter Capital, he was a consultant to early stage tech companies as an angel investor with Element 8 and CFO of Power Efficiency Corporations. Early in his career, BJ spent 5 years as the vice president of and director of Summit Energy Ventures, a VC firm focused on investments in energy technologies. And lastly, but not least, let me introduce Adam Zeigen, who's the co-founder and CEO of Rock My World, a digital health fitness startup focused on using smart media to help people lead healthier lives, more active lives. Its flagship product, Rock My Run, which debuted #3 fitness app in the App Store, helps active people have more fun and perform better during workouts by providing motivating music that changes in real time. And they recently launched a new app, Joy AI, a chatbot powered by artificial intelligence that uses proven physiological techniques to help office movers move more throughout their day. Welcome, Adam, Linda, and BJ. And with that, let's get started. We're going to start with first addressing what I would categorize as the information and insights on revenue-based financing. And I'm going to ask Caitlin if you can bring up the other slides.
Certainly, I'll go ahead and do that while you're chatting.
Okay. And in this section, we're going to cover what is revenue-based financing and specifically what are the criteria for considering that. And with that, BJ, good morning.
Good morning. Thanks everybody for attending, and glad to be a part of the webinar. So
right.
This slide gives a, oops, sorry, go ahead.
I was going to say, take it away on this information and insights on revenue-based financing.
Yeah, great. Thanks, Kim. This slide is really trying to give an overview of what it is, and as Kim mentioned, it's a structure about which a lot of people have questions. So this is sort of giving an overview of how revenue-based financing works. It's a structure that, as you'll see, is meant to be sort of an in-betweener between debt and equity. So what it's really structured like is like a royalty agreement where the capital provider, like a Ryder Capital or Kim's Group, is providing capital to a company and is getting paid a certain percentage of that company's revenue each month, typically. So that happens each month. So it's a flexible payment type of instrument, and that's the whole goal. Is it's flexible for the companies and it goes up and down as the revenue goes up and down, as you see in the chart on the right. An example of revenue-based financing, and here we have at the bottom, it's like a $100,000 loan, for example, could be you then pay 5% of revenue until a total amount of money that's set at the beginning of the loan. That total amount of money might be $160,000. For us, that'd probably be like a 4-year type of arrangement. We'd expect that to be paid over 4 years. The good thing about revenue-based financing is there's no equity involved at all, so you don't get any sort of dilution if you're the entrepreneur. And there's a deep alignment between the entrepreneur and the capital provider because both groups have an incentive to grow the business. Taking our example here of the $100,000 loan, if this is targeted to be paid over 4 years, let's say the company grows more quickly than the capital provider thinks. Well, then if the company grows more quickly, it'll pay the $160,000 more quickly. And that means that the investor gets a higher IRR. Kind of like equity. If the company is really successful, the investor does well. And of course, so does the entrepreneur if the company is really successful. On the other hand, if the company doesn't grow as quickly as everybody wants, then maybe it'll take more than 4 years to pay that out. And in which case the entrepreneur doesn't have as successful a business as they wanted, and the investor also doesn't have as high a return as they wanted, but they're both in it together is the whole point, much like equity, and yet, again, there's no dilution. So as you go through and think about where this kind of revenue-based financing fit in the capital stack, right? So everyone's mostly familiar with building emerging companies. They're really familiar with equity. Most people think of going and getting venture capital and such. In reality, only about 1% of startups actually raise venture capital. They get a preponderance of the media coverage and things like that, but actually most entrepreneurs build their businesses and make money not by utilizing venture capital, but by using other kinds of capital sources, sometimes angels and things like that, but that's all typically equity money. And historically, equity money is really all there's been for sort of early stage growth capital. It's been really the only option. So in this slide here, sort of show the classic two forms of financing, debt and equity. Debt is very, very typically, most commonly it's obviously associated with a bank. Where it's really, really concerned about being low risk, and they're typically incredibly low return. Whereas equity is obviously on the other side of the spectrum, and that's equity whether it's from a VC or whether it's an investor in common stock. And that's associated with what an angel investor would do, a VC, or of course the entrepreneur themselves. Revenue-based financing is really intended to be kind of a tweener, sitting in the middle between the two. the way different revenue-based financing providers structure it, some of them structure it more like equity, some structure it more like debt. At Lighter Capital, we structure it officially as debt, but the way that the economics work is really kind of in the middle, and it's meant to be sitting in the middle. So, like I said, there's a deep alignment between the entrepreneur and the capital provider towards growth. When you have a typical loan, you really don't have a lot of incentive for the capital provider to push growth. They really want safety. They just want to make sure they get their set payment every month. Whereas for revenue-based financing, you really want to help the entrepreneurs grow and see that growth. And at the same point in time, it's obviously not quite as risky as equity because it's senior in the capital stack, and so that means it gets paid out first if there's something goes wrong or when the company is sold. So it is safer than equity, and therefore, generally speaking, that the cost of capital, the sort of risk reward, is sitting in the middle of the spectrum, somewhere between debt and equity. And that's all we've really got on the basic structuring of revenue-based financing and such. So with that, I'll turn it back over to Kim.
Well, the next set of questions, well, thanks so much for sharing that. I think that, you point out a really great point about that it's aligned with the entrepreneur's interests in that, as their revenues fluctuate, their payments fluctuate, and it's not fixed like traditional, debt instruments, right? And then the next, just continuing on with this section, is looking at it from the criteria for considering funding. I thought that, BJ, if you can speak to that a bit. Now, I understand you're going to talk about it from the perspective of of your program, but I think overall in general, if you can speak to that, I think you have some slides around that question.
Sure. Yeah. So we here at Lighter Capital, obviously, we're just one provider. So as Kim sort of mentioned, you really have to look at different providers of revenue-based financing and see what their minimums are. But this is really what we look for. What's sitting up here on the slides. Really, the quick summary is that we want the company to have at least $15,000 a month in revenue, ideally recurring revenue. We're really looking mostly at sort of recurring revenue type companies. We really want to see that $15,000 because we believe at that point a company has a certain amount of product market fit, right? Assuming that $15,000 in revenue isn't to the entrepreneur's uncle or something like that. That means you've got a bunch of paying customers out there. And typically, we want to see at least 10 customers. So we want to see some diversity of the customers out there paying for it. We want to see high gross margins, typically 50% or higher. Depending upon the kind of business, that can be fairly easy. Then it might be really hard. If you're a software business, typically 50% is not too much of an issue. Even for software and services types of businesses, it's not too much of an issue. But it does mean that with that requirement, we typically are funding companies in the tech arena that tend to have high gross margins. They can expand pretty quickly, and for every dollar in revenue they make, they keep a high portion of its gross profit. For us, we're not a funder typically of companies that are profitable. We do fund companies sometimes that are profitable, but most of the companies we fund are burning some cash. They're in a growth mode. They want to put their foot on the gas and hire several salespeople or launch a new product feature or hire some developers or something of that sort. So we expect that they're going to be burning through our money and such. So, but what we do want to see is that they're not burning so much money that they're going to run into a wall and they can control it. So if they have to downsize, they can do that. But ideally, they sort of grow into being cash flow positive over time. And that's really the core of what we look for.
Well, thanks so much for sharing that. And then do you have some insights with regards to this criteria from the investor perspective? That is for us the investor perspective of what we're kind of looking for. The entrepreneur, okay. Is you thinking of? Okay. Yes, for the entrepreneur. Yeah, for the entrepreneur, really, I think that
where revenue-based financing can fit in best is a variety of different situations. In general, the way we think about lighter capital is we tend to fund entrepreneurs that are kind of one of two mindsets. One is one that wants to really minimize dilution and maybe never wants to sell equity in the business at all. We kind of call those the never VC mindset. And it doesn't need to be VC, it might be angels or whatever, but they really don't want to sell equity, and they're sort of holding on to that very preciously. And about 45% of the companies that we fund are bootstrapped. For us, bootstrap means sometimes they put in the money themselves or family and friends, but it's pretty closely held. The other mindset that we see is people who want to do sort of VC later. So we call them sort of VC never and VC later type of mindsets. And the VC later folks really want to push off an equity raise until later when the company's bigger, it's reached certain milestones, it can get a better valuation, maybe they picked up the growth rate, things like that. So the ways of using revenue-based financing we found to be most sort of interesting or most helpful for a lot of the entrepreneurs is to sometimes skip a round of equity financing. A lot of companies, and everyone's probably familiar with VC financing. You see companies doing a seed round, Series A, Series B, and so on and so on and so on. And by the time you typically get to a Series C or D, the entrepreneurs that at one point in time owned 100% are down to somewhere in the 5 to 10% range typically. If you can skip even just a single round of financing, you'll often end up owning a whole lot more of the business, somewhere in the 10 to 15% type of range. So it means a whole lot of difference if you're going to be raising a whole lot of equity. Just being able to skip a round of financing is incredibly important, and revenue-based financing can help you do that. So we see all those entrepreneurs sort of skipping around or pushing off equity, as well as entrepreneurs who never want to raise equity but do want some sort of growth capital. There just aren't a lot of options out there for good growth capital except for equity.
So thanks so much for sharing that. Just kind of digging a little deeper from the entrepreneur's perspective is that for a company that could be seed stage, meaning they're revenue generating, and so this is a viable option for them, as well as if they may be Series A, which, depending on what region you're in, there's an expectation that you're at 100 to 200,000 month over month, and you're growing at 50% month over month. And, depending on if you are a B to C or B to B, you may have some other engagement hoops to that you must achieve in order to get access to institutional money. Depending on if maybe you did take outside seed money, but you're not, achieving those, either 100, 200K month over month or 50% growth month over month. Can you speak to some of those companies that may look to revenue-based financing as an option, or how they may evaluate it when they're looking at this as an alternative?
Yeah. For revenue-based financing providers, like investors, you really want to see some growth in the business. That's important, right? So because you're getting paid a percentage of revenue, you want to see that percentage is going to grow over time. The whole idea is the company is going to pay you less today, but start paying you more tomorrow when they're bigger and they can afford it. That's better for the company. It's better for the investor in terms of being a part of sort of a growing business. That said, companies don't need to be growing at those extreme rates like you mentioned for a revenue-based investor to make very good, appropriate returns, risk-adjusted returns. A lot of the companies that we fund might be growing 20 or 30 or 40% per year. They're not growing at 150%. We fund companies that are growing at like 500% per year. We fund companies that are growing at 10% per year. As long as we have a good understanding of what the expectations are from them and from us, and where they're going to go with the business, and if there's an intention to go grow, and we think there's capacity to go do that, then we're all in. And as long as we're reasonably accurate about figuring out how fast they'll grow, then we can get the type of return we're looking for, and we're very happy as an investor. And then hopefully the entrepreneurs are happy as well, since they're growing, hopefully at the rates they really want to. And building a business they want to. So as long as there's alignment more around the pace of growth between the entrepreneur and the capital provider, that's really in some ways more important than the actual absolute rate of growth. Whereas for an equity investor, you just want faster growth, and faster growth because it gets you higher valuations and such in the future. Since revenue-based financing is not based at all on a valuation of the equity, it really doesn't matter quite as much that you get these, like 10% month over month type of growth rates that you really need to go raise equity a lot of times.
And another important factor that I'm certain many entrepreneurs would want to understand is what's the process. Once they say, okay, I get it, and I see this as a great opportunity. What's the process and timeline that they typically need to go through?
Yeah, for us at Lighter Capital, we use a lot of software to try and expedite the process and such, try and expedite, automate some of the data collection process. Typically, it's about 45 to 60 days from sort of initial contact with a company to funding, and actually, the day of funding and such. It's a relatively standard, in some ways, investment process, but we try to expedite in terms of data collection, and that tends to make it a little bit faster and a little bit less onerous on the entrepreneurs, right? So we can automatically tap into QuickBooks and things like that and pull financial statements and such. That makes it a little easier than an entrepreneur exporting it from QuickBooks and sending over an Excel file, like sort of going through it with an associate or an analyst on the phone and things like that. That always takes a lot of time. So we really try to standardize that process a bit to make it easier or lighter, as that's the name of Lighter Capital, lighter on the entrepreneurs to go do that. But it's overall a relatively standard process and relatively standard documents and things like that, and standard terms outside of the economics like we've been talking about here.
Well, that's great, because when you compare that to traditional equity financing, which may be a 6-month process, and a lot of bias that goes into whether or not it's going to close sometimes, or the other route is for people who look at debt financing, and they may consider the SBA financing, which can also take 6 months or more, depending on the lender. This may be a definitely more efficient alternative. So next,
go ahead.
Next, I'd like to turn our discussion into equalizing access to capital. When you think about it, what are the typical funding options for founders and communities that have often been underserved in capital sources, especially banks and VCs? When you think about that specific issue, how does RBF, excuse me, I'm fighting a cold. How does RBF address the lack of access to capital for founders who are women or minorities? BJ, could you speak a little bit about how your data-driven model is not subjective?
Yeah, let me take that over. Kim, sounds like I feel for you over there. The way that we look and evaluate businesses is really on the data and on sort of the merits of the business. I mean, we're looking at the financials, we're looking at all the sort of stats and metrics of the business, and really looking at that. We also, frankly, do look at the entrepreneurs. We really look at the entrepreneurs in terms of their understanding of the business. Do they seem to have their arms around all the key moving pieces? Can they, eloquently state what their goals are and how they're going through it and what the unit economics are and things like that? And because, interestingly enough, we use a lot of technology to evaluate the businesses, and we evaluate them from far. We typically actually don't meet the entrepreneurs before we fund them. So although you obviously can frequently tell the difference between a woman and a man's voice on the phone or whatever, we really don't meet the people, and so we don't tend to have some of the, I think, biases that can come from people's sort of the perceptions and prejudices and such. To us, it's really like mostly looking at the data on a screen and looking at the business and understanding sort of in software how the entrepreneur is thinking about the business, and then having a series of phone calls where we just talk about what they want to do with the business. That's really how we do this. So it is something that I think can, very much sort of be overcomes a lot of those biases. It's not a factor for us. Also, we also use a very quantitatively driven way of looking at a company and then setting a targeted IRR, and that quantitative method has a bunch of different inputs to it and such, looking at revenue and things like that. And of course, none of those are based on gender or race or anything like that. It seems obvious, but should probably clearly be stated that certainly wouldn't be the case, and it's not something we really actively track. There are certain lending laws and stuff like that prohibit it, but also, frankly, it's just something we don't really believe is a factor. There's an interesting side note too. We really don't look at a lot of this sort of traditional credit metrics that a lot of sort of banks and stuff have historically used and have historically used at times to sort of in somewhat shady ways exclude lending to minorities and women and things like that in the past. So we really don't pay attention to all those factors.
So it would be fair to say, from a revenue-based financing standpoint, most of it is looked at the performance of the business and the metrics such as gross margin, growth rates, the strength of the customer base and the adoption of the product, than looking at the individuals.
Yep. For us, it certainly is. I mean, like I said, we still pay attention to the individuals some, but it's mostly, talking to them on a phone and hearing about how they articulate their business and things like that. And do they seem like they have their arms around it? And then, of course, as any capital provider, if somebody tells you a lie or something like that, that's no good. But it's really fundamentally about a sort of an analysis process that goes on about the data and then how the entrepreneur speaks to that data and speaks to their desires for the business going forward. So it is really very much data driven and the performance of the business, driven by the performance of the business, like you mentioned. Not as much like with VC classically, it's very much a people driven type of thing. And so what often can happen, and listen, I sort of consider myself like a reformed or a recovering VC. A lot of times in VC, you're making a decision about the people, and the people are important when you're planning to take an equity investment in something that's a very early stage enterprise, incredibly highly risky. People do make a huge difference. If you have great people running a business, they can have a terrible idea, but great people, and you will vastly outperform a great idea with terrible people. Mm-hmm. That's true, but the problem with that is it leads to an incredible amount of bias, because VCs then tend to sort of naturally fund people that sort of look and act like them, and sort of birds of a feather tend to flock together. So your sort of stereotypical example is, we were buddies or roommates at Stanford Graduate School of Business, so I'll give you some funding and such. That tends to pervade VC a little bit because they're making decisions that are very, very qualitative about people, and so bias is so easily comes into those decisions, where it's really, we're very much more about the data.
Another key element with regards to revenue-based financing is it has an automated built-in flexibility such that, the reality is, growing a business is a challenge and you're going to have some ups and downs. And the revenue-based financing has that automatically built into it. This can be a big help to, early stage companies that may have, as they work through their adoption, some lumpy revenue streams.
Yep, absolutely. It definitely can help with that because, by its very nature, it's meant to do that. That's the risk that you're taking as an investor in revenue-based financing. You're taking the risk that, some months are going to be great and some months are going to be bad. And so we literally have some of our customers that they may have 10 paying customers, kind of like our minimum. And a lot of times the companies that we're funding get prepaid annual payments. So, if you got 10 customers and they're all doing annual payments, well, you're going to have at least 2 months where you don't get paid at all as a revenue-based funder because they're not getting any cash into the company. So they get no cash in, we get no payment, and that's the deal. And so that certainly happens, and I think it can provide a lot of flexibility for the companies. It's also speaks a little bit to, between the people and the funding source, I think it speaks a little bit to the relationship between a revenue-based financing provider and the entrepreneur versus, say, a VC and the entrepreneur. I mean, VCs, you typically sit on a board. They effectively, you know, when you're bringing on a VC investor, you're selling off part of your business. You have a co-owner, and that co-owner sits on the board, and it becomes, to the entrepreneur, it becomes your boss in a lot of ways. With revenue-based financing, like we don't sit on boards, we don't do any of that stuff. We're there to help, but really, we actually are much more concerned about locking the entrepreneurs into the business. We really want them there. The last thing we want to do is be responsible for coming in and operating a business or being that hands-on in that type of regard. It's really a very different relationship between the entrepreneur and the capital provider, I think, than certainly when I was a VC.
One more item that I want to touch in this area has to do with how revenue-based financing does help a founder preserve capital and why it's important. You know, I shared, you know, many of you all's backgrounds, but, you know, as a serial tech entrepreneur who has raised, you know, quite a bit of VC money, you know, just as you said, you're selling a significant portion of your company. And so being able to have a strategy that preserves founders' equity is important. You know, the thing with revenue-based financing is there's not the selling of equity or dilution that goes along with that. It allows for preserving the equity that investors can either invest in their business and have a positive impact in their community, as well as build wealth for the individuals. One of the practices that we look at with regards to Founders First is that being able to have, you know, since we do focus on the mostly underserved founders, that allowing them to preserve that wealth within personally, as well as you know, being able to use it amongst their employees. But would love to hear Leiter's perspective on this.
Yeah, we're very much the same mentality, and we really want the entrepreneurs to get the lion's share. They're the ones really taking like the massive risks and putting the sleepless nights into the businesses. So we really want to see them end up with a lion's share of the gains when they're building a successful business. It seems, you know, not only just fair and right that they should be able to do that. And then, yeah, obviously, we love to see entrepreneurs invest back into their communities and back into other entrepreneurs once they're successful. And by investing back in, sometimes that's money, sometimes it's mentoring and advice. And we try to foster that a bit between the different companies that we funded and try and create a bit of a community there for them to do that.
Great. Well, I'd like to now turn it over to hear our entrepreneur's perspective from both Linda and Adam. You know, from your perspective, how and when as an entrepreneur did you consider a revenue-based financing option? Adam, if you wouldn't mind sharing first.
Yeah, sure. Thanks, Kim, and good morning. In terms of considering revenue-based financing, it really made a lot of sense to us once we had figured out some stable unit economics, meaning we knew how much it cost us to acquire a customer, and we knew the lifetime value of that customer, and then we could arbitrage the difference. That's really when I think revenue-based financing makes the most sense. Because once your business or your product is to that point, you've literally just built a machine, and you can put money in one end, and you have a reasonable degree of confidence that more money, and exactly how much more money, will come out the other end. Because I mean, and this applies to, you know, frankly, any form of financing that has a debt component to it. You do have to pay back more than you're getting, right? And so you have to ensure that you have a business that has some form of predictable revenue generation that you feel confident in before you would consider, you know, taking on that type of financing. So for us, that was a really key component, having those unit economics in place for us to consider this type of financing.
Well, thanks for sharing that. Linda, would you mind sharing when it made sense for you to consider this option?
Sure. Well, we had actually explored several different options, from the traditional going to the bank, line of credit, to having our debt looked at as or even our receivables as a collateral. And the thing that we kept noticing was that it was a very slow process, and the risk that was there was higher. Because we had a lumpy cash flow. We couldn't predict when our clients were actually going to pay us. Even though that we had terms with them, doesn't mean that they always pay when they say. And that can have a devastating impact if we would not be able to service the loan. So the really beauty part of it, when we researched and we looked at different companies that provide revenue-based funding, that we found that it was a really good selection for us. It fit our business need and helped us with moving forward without the risk of being in debt to the bank.
Mm-hmm. Well, thanks for sharing that. I'm going to ask for you guys to go a little bit deeper when you think of sharing a scenario about your business, because Adam, yours is more of a tech-enabled business, where Linda, yours is contracted revenue business. Would you mind, Linda, starting first about just sharing a little bit of background about your contracting business and how that is, how it has, but revenue-based financing has been a fit with regards to your scenario?
Sure. The technology business, especially the portion that we're in and doing collaboration tools for clients, which would look like an intranet, that internal corporate communications avenue, especially with people who have a dispersed workforce across a region, or actually tool so that they can actually connect and communicate with each other. And it is a contract-based business, so we do the proposals, and it's a long cycle. It could take several months before something gets approved, and you start the work, and you may get a piece of it up front to pay for licensing and for some of the services, but the projects can last a fairly long time. So payment is very, very lumpy in that. What we were able to do, and I'm so excited about this, because the revenue-based funding actually, believe it or not, allowed us to hire a person, so we could add some services component and start doing recurring revenue, so that would help mitigate some of that lumpiness that would take place. And it would sustain us for those periods of time when the flow of money wasn't coming in from the contracts. And because we were able to hire a person who could manage that support mechanism, we then could free up some of our resources to start working on tools that would actually generate a recurring revenue. And that was because of the revenue-based funding. We were able to get through that. Otherwise, all of our resources were all focused on the contracts and the delivery, so it was fast or famine.
Thanks for sharing that. Adam, you've launched as a tech-enabled recurring revenue business. Mind sharing a bit more about a scenario of how revenue-based financing has applied as an alternative for funding your growth?
Sure. And so by way of background, my company launched with primarily a direct-to-consumer mobile app initially, and we raised initially some equity-based financing from angel investors and some strategic investors prior to seeking revenue-based financing. And that initial funding really enabled us to get to market, establish product market fit, and ultimately develop our reoccurring revenue model. And so for us, revenue-based financing came into play, as I mentioned before, once we had that really stable, predictable cash flow. And so we decided to go the revenue-based financing route once we had been in business for I think it had been about three years, because we've been with Lighter Capital now for over a year. So once we had really that track record of being able to perform, being able to deploy other capital effectively, and really understanding our go-to-market channels, what channels performed, what was the maximum we could pay to acquire a user through, through primarily advertising. Once we understood all the various points in the funnel, the conversion rates, in the mobile app world, you have it from clicking an advertisement to downloading the application to creating an account to subscribing to our service. Once we understood each one of those steps and the percentage of users that flowed through it, then we just could very clearly articulate, okay, we know if we spend X, we will be able to generate Y. And so that made the process of working with Lighter very, very easy because we could demonstrate we had established this funnel. We could demonstrate it had been working for a period of time, and all we needed was capital to be able to fuel it. And so, it wasn't until we got to that point that it made sense. But once we were there, it was very easy and seamless to do.
Well, that's great. Thanks for sharing that, Linda and Adam. From a perspective of how do you manage your business after you've taken on funding your growth with revenue-based financing? Linda, would you mind sharing your perspective with regards to that?
Well, my management of the business hasn't changed a lot. So in other words, it's been great having expert advisors to go to and seek information, but they don't insert themselves into my business and how we operate. The value, their expertise in areas that we're not strong. For example, in the marketing side of the house, because we were so into our projects and our business came from referrals of one person referring us to another. It was we had business coming in through the door, so there wasn't, quote, the marketing. But as we start to switch and want to look at the growth, that we could sustain, but growing it, that just wasn't going to work. And the expertise that we got on the marketing strategies and how to do the sales and how to open the doors and actually present our solutions is invaluable. It's been phenomenal in the amount of growth that we had, but that area of expertise, and that's the one thing that in our case, Founders actually brings forward, is a group of people that we can tap into, which makes a difference.
Thanks for sharing that. Adam, how would you say that you're managing your business at all differently since you've taken on revenue-based financing?
Yeah, I would agree with Linda. I haven't how I manage the business hasn't dramatically changed. Now, as a result of taking on the financing, we've grown, and that's enabled us to hire more people, and so it's more of a function of how has the financing enabled us to grow that has changed how we manage things. We have to, as you grow, you have to put in more process. You have to put in more structure. You have to develop programs for your team that maybe you didn't have to have when you were a smaller team. So I think the changes in management are more related to just a growing business and one that is growing faster than it had previous to the financing, more so than as a result of the source of the capital in general.
That's great to hear that both of you guys are, running a growing business. Would you mind sharing, how much your business may have grown either in team or customer base since you took on the funding?
Yeah, this is Linda. I'll go first. We've actually we're getting ready to do more hiring, so that's a good sign, right? But from a revenue perspective, we doubled our revenue year over year. So we're coming in 100% above last year.
And that's fantastic. Fantastic. Adam, would you mind sharing any insight as to your growth since you initially went through your funding?
Sure. Yeah, I don't know the figures off the top of my head, but they're somewhere in the 50 to 70% range in terms of revenue. In terms of team size, and I'm trying to think of when we actually closed the deal with Lighter. I think it was last summer. So in that sense, we've increased the size of our team by about 25%. So yeah, I mean, it's as a result of it, it definitely has led to some growth for us.
Adam, in your perspective, if you were going to give advice to another entrepreneur as far as considering when they're evaluating different funding options, what might you share when you compare, the three that we've talked about, equity versus revenue-based financing versus traditional debt, as far as looking at it from where you are with growing your business?
Yeah, I think I would start with giving or asking the entrepreneur what their goal is, because I think that really is a big part of the decision of where to source your capital from. If your desire is to grow a lifestyle business, then certainly equity-based financing just isn't really a path to go down. Equity-based financing is obviously important for those who are looking to sell their company, who you need to have an exit in order to raise equity financing, because that's how those investors get paid back. So that would be my first question: is it lifestyle, or is it something that you want to grow quickly? Assuming it's the latter, and therefore you have multiple sources of financing available to you, both equity and debt based, then I think it's a matter of, well, what stage are you in with your business? If you just have an idea and you have very little traction, revenue based financing again isn't going to be a viable option. It's once you have that track record, once you have a product in market, and once you can demonstrate that product is generating revenue, then the decision comes up. I think even in that case, you still want to have an understanding for that entrepreneur. How fast do you want to grow? Because again, revenue-based financing will typically be, in my experience, smaller amounts than what you would get in an equity-based. It will be pretty difficult to bring in $2, $3, $4, $10 million of revenue-based financing. Whereas on an equity standpoint, assuming that you check the appropriate boxes for that type of funding, you can bring that level of money in. So I think it's really comes down to, what do you want to accomplish? What are your goals, and what time frame, and what type of business do you really want to run? Do you want something that is charge fast, move quickly, grow extremely quickly, but the associated risk with it? Or are you looking for something a little bit more slowly in growth, want to ensure that you hang on to your percentage ownership, and you have something that is really repeatable in terms of unit economics?
Okay. Linda, would you have any final thoughts with regards to recommendations for an entrepreneur as they're looking at the various funding options?
I would say that one of the key things is considering all of the options that are there, and that the revenue-based funding is a viable option, especially if they want to retain ownership of their company. That to me was key, and one of the driving factors is we wanted to maintain ownership and control of the company and have a say in how it operates in the day-to-day. So for us, especially the revenue-based funding was the best option.
Right. Well, thanks so much for you guys sharing your entrepreneurial perspective. Let me go back to BJ. Any comments you'd like to share with regards to the entrepreneurial perspective?
No, I mean, listen, I think you covered it really well here, and the team has covered it really well. And the only thing I would say is, this is one of the reasons why we really dove into making lighter capital, was to make an alternative for entrepreneurs that want a different kind of path for fundraising and growing their businesses. And I spent about half my career on the sort of capital provider side and half my career on the operating side, raising money and running around after angels and VCs and things like that. And, it's a pain, it's difficult. So, we're really happy to be associated with great entrepreneurs and with an alternative way for different companies to get funded.
Well, thanks for sharing that. And I so attest to that with launching both Lift and Founders. Our mission was the fact that there is such a growing space in this underserved market. And as we have had the opportunity of working with great companies as they've transitioned from being a pure consulting base to a tech-enabled market, that revenue-based financing allows them to get access to non-biased, flexible capital that works with them as they make that transformation from being transactional or project-based to a recurring, and can have the risk and interest alignment along with the founder. So it's been quite rewarding and exciting. So thanks to everyone. Any last comments that anyone wants to share? Let me see, do we happen to have any questions?
Didn't see too many questions come up, but at any time, if anyone's got anything right now, let's bring that to attention. But a follow-up to this webinar will be the recording, plus the slides that BJ shared and contact information. So that'll all be sent to attendees, whether they were here today or not, and registered for this session.
All right. Well, thanks to everyone for taking time for probably one of the last major productive days in December, although I'm going to try to push through and get a few more things done. And thanks to Adam and BJ and Linda for taking time to share your insights and expertise with regards to this very important topic.
Thanks, Kim.
Thanks, Kim.
Thanks, everyone.
All right. Well, with that, I'll let you guys get to your Friday.
All right.
Thanks.
Thank you.
Thank you.
Bye.